Hi, hello, welcome friends. In continuation with the last class of Forex related chapter. So, what is there in Forex? Yesterday completed the spot market related and forward market. Now we should know about the shift. Role of shift in foreign exchange. What is there? Here, shift means wherever the foreign exchange dealers or traders they will have some network use of network communication. So they will communicate each other by using these shifts. So shift means what? Shift means society for worldwide interbank financial telecommunication, which is purely messaging system. So it is found 1973 and headquartered Liverpool, Belgium near Brussels. So it is one non-profit organization and it has profits around the world. So it employs a dedicated computer network system for communicating fund transfer. So whenever you want to transfer funds, they will use this code, shift code. So where has same like as in GST we have HSN code. So for funds transfer in foreign exchange we will use the shift code. So to avoid the miscommunications, shift may be useful. So shifting assigned codes to currency of each country. So this code contains 3-letter codes and used internationally to cross border communication. So wherever you provided this code, they will understand what is the currency, what is the reason. So for example for codes means here they provided USD, GBP, CNY, CAD, AUD, HKD, and our currency will be INR. Where is their INR? Here Indian will be INR will be the shift code. Now shift uses common language for financial transaction and uses centralized data processing system. It is here important to note the shift is only standardized communication system and not transaction settlement system. So it cannot settle the amounts. So it is just communication. It is like a one message. The shift connects various financial institutions more than 200 countries. So it has connected with more than 200 countries. Here shift plays an important role in foreign exchange dealings. So because why it is important, the reasons will be, first reason will be, in addition to validation statement and documentation, it is form quick settlement has messaging take place within seconds. So it is act like as quick settlement, but it is not a settlement. So it is act as quick settlement, and because of this security and reliable helps to reduce operational risk. So it is reducing the operational risk. And after that, since it enables its customers to standardize the transaction, it brings operational efficiencies and reduce the cost. So cost is reducing because of this, and it also ensures full backup and recovery system. So it will provide backup, and it acts as catalyst that brings financial agency to work together in a collaborative manner for mutual interest. So it will work as a financial agent. So what are the reasons? So reasons will be, firstly it is a quick settlement, and after that it will be secure and reliability. So it is reducing operational risk, and after that it is standard transaction. So it will reduce the cost, and it has fully backup, and it the catalyst with the financial agencies will have mutual interest. And after that, national and international payments gateway. And today news will be, the Google Pay is entering into foreign exchanges. So the Google Pay, you can now, the foreigner persons also can use this Google Pay with the help of this payment gateways only. So a payment gateway is a virtual mode even equivalent to physical mode of transfer of cash, so that authenticates and routes payment details in an extremely secure environment. So the service ranges from collecting and sending payments to bank or to e-commerce sites for carrying out commercial transactions. So here we need to see what is this payment gateway. It is firstly one virtual mode, and here we will authenticate and it will provide the route for payment details. And here the services range from, it will collect and send payments to banks or to e-commerce site for carrying out the commercial transaction. Here the payment gateway functions is essentially encrypted channel, means it will have passwords and which securely passes transaction details from the buyer personal communication, that is personal computer, PCs, mobile phones or tablets, to bank for authorization and approval. So whenever you are doing some payments na, they will ask the numbers, so passwords or screens, so for the purpose of authorization and approval. And it also involves some transfer of data in an encrypted manner from entry point to point sales, so POS sales. So whenever you are entering some shopping malls, they will provide one mission for POS, so point of sales, and after the approval from the banker of debit or credit card, it will complete the transaction. So they will get one OTP verification code. Whenever you swipe the card in the that POS machine, then you will get one OTP. You need to enter that reference code, then only the transaction will be completed. Next, a payment gateway here provides multiple benefits for such as, so what is the benefit for this payment gateway? One is it has 24/7/365, so you can use any time, and it is real time authorization, so it will update fastly, and rapid efficient transaction processing. Multiple payment options will be there, and minimizing the risk by encrypting transaction and verifying other information, and flexible powerful real time reports generation, and facility for customer refund. If there is authorization fair or any problems is there na, they will refund the amount. Next, merchants can get rid of operating complex software and maintaining huge data, so they do not require to maintain all data. Then next, certifying authority authenticated secure servers, so they will have that digital signature services. Certifying authority will be authenticating these servers, and collecting of bulk data in a cost efficient manner with the additional benefit of being checked for card validity. Provisions for multiple host interface will be there, and comprehensive or simple administrative control will be there. Gaining customer support and merchant trust will be there. Here, gaining customer support and merchant trust, despite so many benefits, it has some challenges also. So firstly, we have advantages will be 24/7 it will work, and it will update like a real time update, and it have transaction processing will be very speed transaction process. It have multiple payment option will be there, and it will provide real time report generation and facility for customer refund if there is required, and merchants can get rid of operating complex software and maintaining huge data, and certifying authority or authenticated secure servers, collection of bulk data in cost efficient manner with the additional benefit of being checked for card validity, and provision for multiple host interfaces, comprehensive or simple administrative control. Now, what are the disadvantages for these payment gateways? One is payment may not happen at all simply because the customer may not have account with bank supporting the payment gateway. So if you want to pay any amount with the payment gateway, you must have the bank account. Without having the account with that bank, you cannot pay the amount. Some payment gateways have only limited number of banks, so some payment gateways will allow only some banks only, and there are problems of reliability, delivery, and limited payment avenues, and general lack of trust among customers and doubt about the service provider. Next, here similarly, the domestic payment gateways, they are international payment gateway that offers global or multi-currency payment as well as interface with multiple languages. So these payment gateways will allow multiple languages to work in that case, so chances of customer conversion increases when prospective customers see the price of the product or services in their currency. So they have, we have different shifts now. So if you changed one country, you will get the updated language of that country. And international payment gateway lets merchant offer their international customer the ability to pay in the currency they know best their own, so they will see the ability of to pay the currency. Here payment gateways are not accumulate but also make international payment and transactions easy. Here customer can easy benchmark price. Benchmark price means one standard price, it is quoted in their own currency. Here if anybody is traveling, that traveling person is there, nowadays he is traveling, he is booming like anything. These travelers to US or China or UK or any other country, any expenditure of proceeds by conversion of in to the Indian rupee, it will provide easily to convert how much we are utilized, how much we are spending, how much we required. It is easy for to make the idea for next tour planning. Next, Nostro, Vostro or Loro account. What is this Nostro, Vostro, Loro account? Here, in interbank transactions, foreign exchange is transferred from one account to another account. Here, foreign exchange is transferred from one account to another account and from one center to another center. So, in interbank means if we have different bank transactions will be there. One bank to another bank or one account to one another account or one center to another center, we are exchanging our foreign currency. Therefore, the bank maintain three types of current accounts. So these banks are maintain three types of current account. Why? To order facilitate quick transfer of funds in different currencies. So if you are using different currencies, for the banks will use different currencies. So for the purpose of quick transfer, they are maintaining three types of current accounts. One is Nostro account, one is Vostro account, one is Loro account. So Nostro, Vostro, Loro account. What is meant by Nostro, Vostro, Loro? Nostro and Nostro, Vostro and Loro means here Nostro means ours, means Nostro means ours, Vostro means yours, and Loro means there. So the meaning for Nostro, Vostro, Loro. Nostro means our, Vostro means yours, Loro means theirs. So they will explain here. So Nostro our, Vostro yours, and Loro theirs. So a bank foreign currency maintained by the bank in foreign country and in home currency in that country is known as Nostro. So if your account is maintaining, so one bank is there. So one bank is there. A bank foreign currency account maintained by bank in foreign country and in home currency of that country. So our account is maintained in another country, that is Nostro account. So our account with you, for example Indian bank Swiss Franco account with bank in Switzerland, so they will maintain in their home currency our bank. So Indian bank Swiss franc account with Bank of Switzerland, that is our bank with you. And whereas Vostro means we, Vostro means yours. So here is the account which is held by foreign bank with local bank. So if Citibank maintain an account with State Bank of India, is will be Vostro account for State Bank of India. The account is which is Nostro for one bank and is Vostro for another bank. So when our account with you, it is Nostro, your account with me, it is Vostro. And when the domestic bank uses the account of third party bank which holds a Nostro amount to settle foreign exchange transaction, these type of transactions are included under Loro account. So when it is not yours or it is not ours, so this is their account. So for example HDFC bank has account with Citibank, but IDBI bank does not have any Nostro account with Citibank. Here the banks will be, one will be HDFC bank, one will be HDFC bank is there. So HDFC bank is with Citibank, and Citibank, but IDBI bank does not have any Nostro account with. So IDBI bank does not have any account with Citibank, any Nostro account with Citibank. Here IDBI bank has paid the bill imported machinery from USA on behalf of his customers. So now IDBI bank will approach the HDFC. So where they approach HDFC bank and ask to settle invoice on own itself. So the bank, these persons are imported one machinery, plant and machinery, they do not have account in Citibank, they go with the HDFC, they ask to settle. So they ask to settle. HDFC worked as an intermediary between Citibank and HDFC Bank. So this account is their account. It is settling. It is acting in behalf of the two persons. Then it is known as Loro account. Next, after that, exchanging position. One is here positions are two position. One is exchanging position, another one is cash position. Exchanging position means whatever the total purchase or whatever the total sales commitment of bank to purchase or sell exchange contracts, what whether the actual delivery is taken place or not. So in other words, all transactions for which bank has agreed with counterparty. So if the bank is agreed with the other banks, other person agreed with counterparty or enter into exchange position on the date of contract is known as exchange position. So they are entered one agreement, they are agreed with the other banks, all transaction with bank has agreed with counterparty, then it is exchange position. Whereas cash position, here cash position means it is outstanding balance. It may be debit or credit in bank's notes to account. So since all foreign exchange dealings of bank are routed through notes to account, so cash position means it is notes to account. Same sometimes they will give in question over bought forward. So they will give in question bought forward purchase or bought forward sales they will give. So it will go with the exchange position account. Sometimes they will give the cash amount. So carry forward cash amount means we will write in notes to account. That will be then. We should never, however, be noted all the dealings whether delivery has taken place or not affected. So the exchange position but cash position is affected only when actual delivery has taken place. Next, there are all transactions affecting cash position will affect the exchange position, not vice versa. So here sometimes exchange position will affect cash position and all cash positions will affect the exchange position, but all exchange position will not affect the cash position. That is the scenario. Here Nosto, Vosto, Loro. So they provide one illustration. All illustration and test your knowledge questions will make in another video. Next, exchange rate quotations. Here exchange rate quotation. For exchange rate quotation they are provided American term and European term. So American terms, quotes in American term are the rates quoted in amount of US dollars per unit of foreign currency. So American terms means they provide in US dollars. Here US dollars per unit of foreign currency, while rates quoted in amount of foreign currency per US dollar are known as quotes in European terms. So when quotes in American terms or rates quoted in amount of US dollar per unit of foreign currency, it is American terms, while rates are quoted in amount of foreign currency per, so here amount of US dollar or per US dollar, then it is European terms. For example, they provided US dollar 0.2 per unit of Indian rupee. So per unit, so per unit means it is European terms, is in American quote, while INR 4492 per unit of US dollar is European quote. So they are providing direct quote means European quote, indirect quote means American quote. So direct means it is European, indirect quote means it is American. Now most foreign currencies in the world are quoted in terms of number of units of foreign currency needed to buy one US dollar, that is European term. Now here they will explaining direct quote and indirect quote. So what is the direct quote, what is the indirect quote? Here as indicated earlier, a currency quotation is the price of currency in terms of another currency. So for example, they are providing $1 is equal to 48 rupees. It is direct, whereas mean here that $1 can exchange for 48 rupees. If you give $1 they will give 48 rupees. It is direct quote, where alternatively we may pay 48 to buy $1. So Here we can exchange or we can buy $1 at 48 rupees. A foreign exchange quotation can be either direct quotation and or indirect quotation, so depending on the home currency. So for we have Indian currency, the home currency, so that it is direct quotation. For direct quote means here home currency price is 1 unit foreign currency, and this is aforesaid example of $1 is equal to 48 rupees. It is direct quote for Indians. Whereas indirect quote means it will divided 1 by 48. 48 means here indirect quote means foreign currency price of 1 unit of own currency. The quote will be 1 rupee is equal to 0.0208. How we can get 0.0208? 1 divided by 48, we can get the amount. So whenever the left side, whatever the left side is there now, we will see mainly that one. So it is indirect quote or direct quote, and here direct or indirect quote are reciprocal of each other only, which can be mathematical expressed as follow. So direct is equal to 1 divided by indirect quote and what's the versa. So they are provided some examples for extracting the Bloomberg website. They have taken this foreign exchange expression. So for that they are providing USD, CNY, JPY, HKD. Means this one, what is this? These all are shifts. These all are shifts. They provide the shifts. So the price is provided. So here we need to notice the rates given are direct quotes for each country listed in the first column, and the rates given in columns in the direct indirect for the currency listed in the first row. These all are this and this they are explaining. So in first for the first column is indirect quote for the currency list, and whereas for the rates given in the row are direct quotes. So row is direct quote and columns are indirect quotes. Now we need to know about the bid, offer and spread. Bid means buying rate, offer means selling rate, spread means difference between the bid and offer rate. So now whenever you are entering any market, you need to buy, you need to sell, and you need to get the profits if it is any difference is there. So for that they are providing here bid rate means what, or spot rate means what, or whatever the bid rate, spot rate and spread. Foreign exchange quotes are two-way quotes, so it will be give two rates. Here expressed as bid. Bid means sell rate, or an offer means ask or buy rate. Bid is the price. Bid means sell rate. Bid is the price at which the dealer is willing to buy another currency. Bid means what? The dealer is there na, this person, dealer is ready to buy, willing to buy another currency. This is bid price. And whereas the offer is the rate at which he is willing to sell to another party. So if you want to ready to sell, then it is offer rate. Thus bid is one currency simultaneously and offer in another currency. For example, they provided one example. Here example may dealer may quote Indian rupees 48.8 to 48.9, vice versa dollars. So that means that he is willing to buy dollars at 48.8, that is sell rupees and buy dollars. So while he will sell dollars at 48.9, buy rupees and sell dollars. So the different, whatever the difference will be there, bid and offer is called spread. So difference between the bid and offer, it will become the spread. Here the offer is always higher than the bid as interbank dealers. So make money by buying at bid and selling at offer. So you need to buy at bid and sell at offer. So if you want to get the spread percentage, then if our answer will be bid minus offer divided by bid into 100. Here we need to know about the dealers buy currency. Here he at the same time is selling another currency. So when dealer is buying one currency, he is selling another currency. So when dealer wants to buy, a currency, he or she will ask the other dealer a quote for $7 million. So that second dealer does not know whether the first dealer is interested in buying or selling $1 million. So firstly, what here happened here, dealer is there, one person is the dealer. What he want buy currency. So he want to buy a currency. So he or she will ask the other dealer. So he will ask the another person. Will ask the another person to quote for say $1 million. The second person does not know whether the first dealer is interested in buying or selling $1 million. Now the second dealer would then give two-way quotes. So he will give two-way quotes. So he will give bid and offer a quote. So two-way quote they will give bid and offer quote. When the first dealer is happy with the ask, so if he is happy with the ask and price given by the second dealer, he or she convey one mine, which mean I am buying $1 million for you. So he will tell. And if the first dealer had actually wanted to sell $1 million and had asked a quote and he is happy with the bid price given in the second dealer, so he or she would convey one mine. So first person will sell whenever second dealer he would convey one mine, and first person second dealer you or would convey one yours. So whatever I am selling $1 million to you, that is known as. So when he is buying it is one mine, when it is selling one yours. Now we have cross rates. What is here cross rate means? Cross rate means it is exchange rate which is expressed by pair of currency in which none of the currencies is official currency of the country in which it is quoted. So for example, if the currency exchange rates between Canadian dollar and British pound, so what is their Canadian dollar, Canadian dollar and British pounds is quoted in Indian newspaper, then this would call cross rate since none of the currencies of this pair is Indian rupees. So we want Indian rupees, but in a contact does not have Indian currency, different prices will be there, then it will use the cross rates. So where we have one standard rate and we will convert it into standard rate, from the standard rate to rupee we will convert. Next, PEPs. So PEPs means this is another technical term used in the market. So PEPs means is the price interest point. So it is price interest point. Here it is the smallest unit by which a currency quotation can change. Example, you have USD or INR quoted to customer of INR 61.75. Then minimum value this rate can be changed is either 61.74 or 61.76. so they are given 61.75 the base rate, and it may go down or it may go up. So 61.75 it may go up down or it may go up. In other words, for USD or INR quote the PEPs will be 0.01, means we will deduct from this or we will add from this, we will get the currency quotation. Now in foreign currency quotation is similar to tick size of the share quotation. So whatever the changing is there, that changing will be PEPs. Now however in Indian interbank market USD or INR rate quote is up to 4 decimal points. So hence minimum value changes of the tune will be 0.001. So one in here Indian they will use the 4 decimal, so then PEPs will be 0.001. so we need to consider here. So spot euro or USD is quoted at a bid price 1.0213 and ask price 1.0219, then different will be 19 minus 13, it will become 0.006 is equal to 6 PEPs. So 6 PEPs it will be noted. Next, after that, foreign exchange rate quotation. Forward exchange rate quotation means forward outright contract. Here a contract which where two parties agreed to deliver and a certain amount of currency is fixed rate at some time in future. So forward exchange rate quotation means one contract where the two parties will be there. So one party and another party, they will agree one certain amount for fixed rate at some time in future. So ideally the way in which exchange rate for forward rate will forward rate exchange is quoted in the same for that spot date. For example, if the spot rate is 61.53 or 54, then we want 6 months forward rate quoting, so then we can quote 61.93 or 61.98. So however, for the purpose of market convention is different. Forward rate is not quoted like this but always quoted with the spot rate and forward margin separately. So they will quote separately. In other words, forward rate is not forward exchange rate quotation but is quoted at different between the spot and forward rate. Next, here for the purpose of readers or users, we were calculating the forward rate. So we were calculating the forward rate, the applicable loading of forward margin into the spot rate. So for example, if your foreign exchange dealers is there, so with their foreign exchange dealers is there, they are quoting 6 months forward rate. How much? 40/44 or 40 cross 44, 40 cross 44. So he will even presume that the ongoing spot rate is known to the counterparty and may not even mention here. Even if he were to mention, he will only mention 53 cross 54. So firstly this is forward rate and he will mention for spot 53 cross 54 because there is big figure, in this case 61. So whereas suppose known by the counterparty without ambiguity, then since there is rate fluctuation is very high, then the dealer has no time to quote the rate in very detailed manner, then he will give this PEFs, forward exchange quotation they will provide. So for that, if we give 40/44, so yes 61.53, if he will give 40/44, so then 40/44 means this 53 there na, 53 will be added 40, it will become 61.93 and 44. So after that what is there here? For 54 we need to add 44, it will become 98. So it is 98. They will give this type of quotes for forward rate and spot rate. This is PEP rates. They will give the quotation has like this one only. So dealers will maintain this margin and not for profit margin of the trader. So if the price on the future date is higher, the currency is said to be forward premium. If the price is high, it will become the premium. If it is low, it will become discount. Sometimes it may be loss also. Next, forward point determination. So forward point determination means what? Here the number of basis points. So we will see the basis point from spot rate to arrive at the forward rate in the above discussion. So we are taken some 60 and we are 60.20 and they will give some points, means they will give, if we give points of 0.3 or 3 means we need to add here. So we had seen this one. Now these are basis points. From this basis point to arrive the forward rate. Now forward points also there. So when forward points, we need to add the for that forward rate. The points are added to the spot rate when currency is at premium and deducted from the spot rate when currency is at discount. So they will provide the points. For that points, if spot rate is at premium, we need to add. If the amount is increasing trend, we need to add. If the amount is decreasing trend, we need to deduct. This is the where we need to basis points. So for the basis point we need to add to spot rate, or we need to deduct from the spot rate. When it is discount we need to deduct, when it is premium we need to add. Means for example, if you in the question they will provided 60 to 66, means 60 to 66 means it is increasing trend, means it is premium, we need to add the basis point. If the in question they have provided 60 to 56 means it is decreasing trend, means it is discount, so we need to deduct the basis points. That is the main difference they are provided here. After this forward point we need to know about the broken period forward rate. So broken period forward rate, here interbank exchanges rates are wholesale rate which are applicable to transaction among banks and in the interbank market. So there are large standard amount with standardized due dates, so that the end of January and end of the February hands one, so that however the customer transaction amount are not only smaller or for odd amount, but the due date could also be non-standardized one to that persons. Here whatever the customer transaction is happen, they will export bill of euro. For example, they are giving one export bill euro 12,342.45.67, now getting realized on 10th January or 23rd February. So they are have one time and so on. So the forward rate that is available in the interbank market in terms of forward points, means forward point means you need to add the with spot points. If it is increasing trend, if it is in decreasing trend we need to deduct. Now cannot be applied for such customer transaction. The broken period concept become relevant in such situations. So they get realized on, they do not given certain perfect time, so they provided realized on 10th January or 23rd February and so on. So they are not ending date was provided. So when ending date is not provided we should not add that forward points, because the concept became the relevant for this situation. So we cannot apply the forward point concept here. That is broken period concept is there. So broken period is not there, means ending period is not there. They are giving the export bill and the amount will be released on 10th January and 23rd February and so on. So broken date is not there, so we should not apply the basis point concept here. Next, merchant rate. What is this merchant rate? Merchant rate means it is always interesting to know who fix the exchange rate has quoted to customer, and to realize the nobody fixes but market decide the exchange rate based on the demand and supply. So here rates are the person, the banks decide, no, the banks are not decided. Stock exchange will decide, no, stock exchange will not decide. So based on the market demand and supply, the rates may go up or rate may go down. It will not decide by one person. There it will depend on the market demand and supply, and other relevant factor will be considered. Here RBI often clarify that it does not fix the exchange rate. So RBI also clarify that it will not decide the exchange rate. Through the same breath, RBI also clarify that it will monitor the volatility of Indian rupee exchange rate. So it will monitor the currency, but it cannot decide the exchange rates. In other words, RBI does not control the exchange rate, but it controls the volatility of the movement. So RBI it will control but not control the volatility of movement, but it cannot decide the exchange rates. Here the exchange rate will be decided based on the market demand and supply. By deliberately altering the demand and supply, foreign currency will change based on the demand and supply. The merchant rates will be decided. The exchange, whatever the banks, the interbank market rates will be based on banks exchange rates quoted to customers. So in foreign exchange markets, banks consider customers as merchants. So for banks will consider customers as merchant for historical reason. It may look ridiculous to call an NRI who has remitted dollar to India as merchant, but exchange rates apply to all type of customers, including that are converting inward remittance in USD to INR. So call merchant rate as against the rate quoted to each other by bank in interbank. So if the person is NRI person means non-resident individual. Even though that non-resident individual also the bank will call as merchant. They will provide the rate merchant rate, which is called as interbank rate. This term is important because there are guidelines will be issued by FEDI. FEDI means Foreign Exchange Dealer Association of India. To bank on this merchant rate has there is customer service element involved in this. So what the FEDI will tell in till 1998, this FEDI prescribe the what margins are to be loaded by bank onto ongoing interbank rate. Means in past they will provide LIBOR plus some percentage, so they will provide in past dates till 1998 quoting to customers. So give the customer they will say LIBOR plus 2%, MIBOR plus 2% or Sony plus 2% in past to arrive the merchant rate. This is because most of the customer affecting cost like interest rate were then controlled by the regulatory. So as part of liberalization, bank got the freedom to quote their own rate. So since then, bank decided themselves what should be the margin depending on the bank position. The only rule that it is still existing in FEDI rule book in Rule 58. So after 1998, this will provided the this will given banks to decide the own rate to fix them. So which state that settlement or all merchant transaction should be effected on the principle of rounding of the rupees amount to the nearest whole rupee, that is without paisa. So what they are given condition, don't put your amount in paisas. So 68.5, 66.5, it is not allowable. We need to put in round of rupee. This means if an exporter or an individual has received USD 1234 and if applicable rate is 61.32, then amount to be credited to customer account 75,669 but not 75,668.88. So we not allow that paisas, only rounded figures will be taken. So whatever the amount we will round it to nearest rupee. If it is above 5 we need to add back, if it is less than 0.5 we need to deduct. The rule will be simply applicable for import or outward remittance transactions also. So this rule is more matter when common sense and does not have any meaningful impact of customer transaction. So in fact in some banking software amount is always rounded off here. After discontinuation of gold standards, that is in 1971 by USA, the foreign exchange market was in turmoil. Initially the RBI kept sterling in the contravention currency, pegging the rupees exchange rate for historical reason due to political legacy. So from effective 1975, rupee was delinked for sterling and was linked to basket of currencies. So these rupees were in past we have linked with sterlings. So in 1975 they are delinked from sterlings, they are linked with the basket of currencies. The currencies means we have different currencies, cryptocurrency, bitcoins, etc. It should be noted that concept of RBI or FEDI advising the fixed exchange rate was discontinued long ago, though the sterling schedule was abolished from beginning in 1984. So after 1984 they are abolished this sterling schedule, where FEDI issued detailed guidelines to bank on how to calculate exchange rate under new freedom. Then they will provided minimum and maximum profit margin and maximum spread between the buying and selling rates. So after 1984 they given freedom to the bank to calculate the rate, but they are given the guidelines for minimum and maximum profit margins and minimum maximum spread between the buying and selling rate. All these are now redundant now. So they were arguments for and against the giving freedom to banks. So they have more arguments will be there when freedom is given to banks for loading margins by bank themselves on going interbank rates. However, liberalization was overrule the skepticisms. Now, international divisions. So, international divisions of any bank calculate the merchant rates for variety of transactions. So, they will calculate the rates for these import bills, export bills, inwards, outwards, remittance, etc., etc. So, they will now banks will calculate on their own. They have freedom to calculate the rates and advises the same in the morning with standard spread loaded to all branches. So, head office will calculate and it will inform to all its branches. It is called as card rate, where from merchant rate to it is called as card rate. For walk-in customer, for transaction of small value, what is small varies with bank. So if you have small value means for some banks it will be small, some banks it will be big. So it will depend on the bank. However, for regular customers and for transactions of high value, always better rate is sought for dealing room. So they will give some benefits to whoever regularly working with that bank, and card rates are advised in the margin are generally not changed unless there is too much volatility. If it has too much of volatility, then they will change the margin in card rate. Whereas after that, exchange rate forecasting. So in exchange rate forecasting, foreign exchange market has changed dramatically over a past few years. So the amount traded each day in foreign exchange market are now huge. So we are entering into foreign market. Now it became more. It is increasing challenging and competitive market. Investors and traders need tools to select and analyze the right data from the vast amount of data available to them to help them make good decisions. So whenever we have right data, whenever we have selected data, whenever we have analyzed that data, then we will get the make good decisions. So corporates need to do the exchange rate forecasting for taking decisions. So why the exchange rate forecasting will be doing? Because when they perform this exchange rate forecasting, they will take the proper decision, good decisions with regarding to hedging, short term financing, short term investment, capital budgeting, earning assessments, and long term financing. Whereas hedging means if even though you do not have the money, means you can buy shares or you can sell shares. Short term financing means short term loans will be provided and short term investment will be provided. Earning assessments will be calculated, EARs will be calculated, long term financing will be provided. For this year, for that they provided to calculate this exchange rate forecasting, they provided some techniques. The techniques may be four types. One is technical forecasting, another one is fundamental forecasting, another one is market based forecasting, another one is mixed forecasting. In these four techniques, they provided category of four techniques in technical forecasting. So what is there in technical forecasting? In technical forecasting, it involves the use of predicted historical data will be used in to predict future value. So to predict the future value, they will use the historical data. It is technical forecasting. For example, time series models or speculators may find the models useful for predicting day-to-day movement. However, since the models typically focus on the near future and rarely provided point of range estimates, they are of limited use of to MNC, these multinational corporations. This is technical forecasting. Means technical forecasting means what? They will use the historical data to predict the future price. It is technical forecasting. Whereas fundamental forecasting means it is based on the fundamental relationship between the economic variables and exchange rates. So they will see the relationship between the economic and exchange rates. For example, subject to assessment. For example, subject to assessments, quantitative measurements based on the regression models and sensitive analysis will be considered here. So we see the relationship between the economic variables and exchange rates. Based on that, we will get one idea and we will predict the future value. And here in generally fundamental forecasting is limited by we have uncertain timing of the impacted of factors. The need to forecast factor that have immediate impact on exchange rate. So we have limited by uncertain timing of impact of factors, and need for forecasting factor that have an immediate impact of exchange rates. And some cases it may omission of factors that are not easily quantifiable. If you are omitted some transaction, it is not easy to identifiable, then also our decision may go wrong. And changes in sensitivity of currency market to each factor over a time, that is fundamental factor. So in technical factor we will use the historical data to predict the future value, whereas fundamental forecast we will see the relationship between the economic variables and exchange rate. Based on that we will decide the rates. Next, market based forecasting. So market based forecasting means what? Here it uses market indicators to develop the forecast. So they will use market indicator and to develop the forecast. Here the current spot rate what is there and current forward rate what is there are often used, and since the speculator will ensure that current rates reflect the market expectation of the future exchange rate. So based on the market data they provide forecasting, it is known as market based forecasting. And after that, mixed forecasting. Here it refers to use of combination of forecasting techniques. The actual forecast is weighted average of various forecasts. So here they may use 2 or 3 weighted forecast, that is exchange rate forecasting. So why the exchange rate forecasting? To take the proper decision. For proper decision we need to use the exchange rate forecasting. We need to do the exchange rate forecasting. We for the exchange rate forecasting we have 4 types. So one is technical forecasting, one is fundamental forecasting, one is market based forecasting, one is mixed forecasting. In technical forecasting, using the historical data we will get the future value, whereas fundamental forecasting means we will use the fundamental relationship between the variables, economic variables and exchange rates. Whereas market based means here we will use the market data, that is bid rate, what is the spot rate, what is the forward rate we will use, and based on that we will identify the future wise. Whereas mixed forecasting means we will use the average of above 3 or above 2. And after that, exchange rate determination. So how can exchange rate will be determined? There are major factors that affect the foreign exchange of any country is inflation rate. So we need to see the inflation rate and interest rate. These are the main rates, which interest rate and inflation rate. So these both rates are main important for exchange rate changes. So it may go or it may go. So the impact of this factor has been discussed in the forthcoming paragraph here under the heading of purchasing power parity. So triple P means purchasing power parity and IRP means interest rate parity. So we will discuss about this inflation rate in purchasing power parity, interest rate in interest rate parity. And here firstly you need to know what are the other factors which will impact the foreign exchange rates. So for foreign exchange rate we impact majorly one is inflation rate, another one is interest rate. Inflation rate will be discussed in the concept of purchasing power parity, and interest rate concept will be discussed in interest rate parity. Other than these two, another factors which will impact the foreign exchange rates. So what are that? One is deficit or surpluses on capital or current account. So whatever the in capital or current account we have deficit or surpluses, so based on the foreign exchange rate will be changed. A currency deficit or surplus on both capital and current account plays a big role in determination of its exchange rate. So while deficit in current account leads to depreciation of currency, the surplus results in appreciation of home currency. So we will see what is the depreciation or it is there any surplus amount for results of appreciation of home currency. Or if in case of capital account, if net inflows is positive, in capital account if net inflows, cash inflows is positive, then home currency is appreciated, so it will be treated as home currency is appreciated. If currency is in capital account currency is depreciated, means it is oversupply. This will one factor which is foreign exchange may change. After that, trade barriers. So what are the barriers will be there? Generally with the increase in trade barriers or quota restrictions for import of goods from any country, the value of own currency appreciate in the long run. So for example, if India puts some restriction on import from China for any goods, the demand for Indian goods will be increased and will be sold for higher prices. So trade barriers, if you have any trade barriers are increasing, the foreign exchange rates may change. And after that, intervention by central bank. So sometimes banks may intervene, sometimes to regulate the price of foreign exchange. The central bank or monetary authorities of country intervenes by selling or buying foreign exchange in or from the market. Next, government will control. So for to control the exchange rate, government such as restrictions of FDI, FPI or repatriation of foreign exchange also affected the foreign exchange rates. Next, expectation, that is bandwagon effect. Bandwagon effect, here sometimes speculations by the speculators on any currency can have substantial impact on exchanges. So here we have speculations as done by the speculators. So on any currency how substantially impact on exchange rates. So when a dominant speculator in foreign exchange market expects fall in value of any currency and he starts taking short position in the same currency. So when person is thinking market is falling down in any currency, then he will take another market, he will take one short position to speculate that loss. This will ultimately result in fall in value of some same currency. This is known as exchange rate determination. So for the exchange rate determination, we need to know about the inflation rate and interest rate. Inflation rate will be discussed in purchasing power parity and interest rate will be discussed in interest rate parity. Other than these two, we have another 5 determinations for exchange rate. One is deficit or surplus and capital or current account. Based on that, we will decide the foreign exchange rate. And trade barriers, what are the trade barriers we have? Based on the trade barrier, we will decide the buying and sell forward exchange rate. Intervention of central bank. So central bank sometimes to regulate the foreign exchange, they will intervene in between, they will change the rates. And government control. So for the purpose of control, they will use the foreign exchange rate, they will determine sometimes government. And expectations, bandwagon effects. So some speculators will decide one substantial impact will be there in exchange. So some speculator is thinking rates will be going down, so but rate is going up, so then he will go with the short position. So it will also change the exchange rate determination cases. Now we need to know about the this interest rate parity and purchasing power parity. So in purchasing power parity, we will discuss on inflation. Interest rate parity means we will discuss about interest. We need to compare the interest comparison for purchasing power, interest rate theory, and another one will come lastly, international Fisher effect. So we need to compare these three, get some idea. And after that we will start with foreign exchange market. Who will be there, who are the participants in foreign exchange, we will discuss. After that we will go with the foreign exchange exposures.